Welcome to the Daily Update. This is Being Prepared Tuesday, September 13th, where we'll look at the action in the market today and then see how things look for Wednesday, September 14th. And it was a really negative day, down over 4% on the S&P. And the markets have yet again been fooled by a narrative that they were trying to create that inflation may be topping out and coming down. And even though we see some evidence of that in the economic reports, well, the Fed is not saying that. And the CPI report that came out on Tuesday, that also didn't suggest that this scenario is changing anytime soon for the better. In fact, if anything, it's changing for the worse. And the market didn't like this report. They were expecting the CPI to decline. A lot of this was coming from gas prices being lower. Well, that didn't really help out. And so we saw a really, really strong decline. In fact, some of our indicators, we saw such a big decline, it's like they're in shock right now because some of the indicators that were pointing up, yeah, they declined, but not by very much. But we've switched back now to a pretty negative stance. So let's go back and talk about what happened. We had a massive gap lower. We went below S1, S2, and S3 at 4,033. We went below S4 at 39.98. So we broke down below 4,000. Now, I don't know if there's an S5, an F6, S6, or I've never seen declines that big in one day to ever need those kinds of calculations. But we just saw a big, big down day across the board. Then after we fell, prices went sideways until there was more selling that took prices even lower. Going into the close, we closed almost at the low. So there's really very little, if any, buying coming in. We were down 4.32%. Volume was above average. It was a pretty steep down day. Now, a lot of the perma bears out there, they're just having a party right now and congratulating themselves of how happy they are and how right they've been, even though that they've been wrong for the last 20 plus years as a whole. Eventually, if you say the same thing, you will be right. Now we have to try to figure out, where do we go from here? The technicals have switched way back to negative, and pretty much the whole positive scenario, the improvements that we were seeing have, for the most part, unless we see some kind of significant bounce, they've been wiped out as of right now because of inflation and interest rates and growth concerns. It looks like the Fed's going to have to continue not only with their 75 basis point move, there's even talk of a full percentage point basis move at the September 21st meeting. And I'll show you that. That's the big debate right now that's going back and forth, or the big fixation that everybody's concerned about. So, what are some comments? Stocks created an unrealistic inflation scenario again. This isn't the first time this has happened. This is the third or fourth time that they tried to run with this scenario only to be stopped and reversed and got caught on the wrong side yet again. So that's why we saw the big decline. The CPI did not decline as much as hoped, mainly because of lower gas prices, as I mentioned. And then they're even suggesting that there could be a 1% increase in the Fed funds rate at the September 21st meeting. The S&P and the NASDAQ, needless to say, dropped below their 50-period simple moving averages. And the trend line that was building up some support that we kind of launched up out of, we've closed below that now. So things have really switched back to a much more negative stance. We still have more reports coming out. PPI will be coming out on Wednesday. We have retail sales, which that makes up a huge part of the U.S. economy. What's that going to do? And then we have consumer sentiment on Friday. We still have the 10 to the 5 and the 10 to the 2 yield curves being inverted. The 3-month has not dropped into inverted territory yet. Sentiment with the down day is becoming more fearful, but not extreme at this point. Other economic reports that came out, the NFIB small business optimism, it came in at 91.8, which was actually a bit of an improvement. The last time we saw this, it was at 89.9. And then here's CPI. It increased 0.1% on a month over month basis. They expected it to be down 0.1%. And that's just in the big CPI number itself. Then they have this thing called the core CPI, where they take out food and energy, and it rose 0.6% on a month over month basis, double what they expected it at 0.3%. And that left the year over year increases at 8.3% for the total CPI. And that's pretty much the same as what we saw before. So we didn't see a decline, and they were thinking it would decline. And then I guess that's down just a little bit versus 8.5 in July, and then 6.3 for the core, which the last time we saw this, it was at 5.9. So it's just not, it's exactly what the market did not want is what happened. Then the Treasury budget, it showed a deficit of 219.6 billion versus 170.6 billion a year ago. So they're increasing their debt there. These other reports are not, they're important, but they're not as influential. Now, another thing that's happened is our trend has switched back to negative. The red line has crossed below the green line on the ADX, but it's dropped below 20 now. So for the time being, we are in a trendless environment. The bias naturally has to switch over to negative because of the strong down day. And now I've switched the momentum being mixed if we see some kind of a bounce, but with a real negative slant to it, because a lot of damage was done. There were a lot of setups suggesting that things were improving, and pretty much all of those got wiped out in Tuesday's session. So let's go back and talk about it. Here is the report. Now, there's the number that came out, 8.3%. But as I point out, every time we get these reports, there's some alternative ways of looking at this. If you go back to the way that they calculated inflation in 1990, we would be up around 12, 13% or so. They've reworked how this is all figured out to make it not seem as bad as it really is. The red or yellow line or orange right here, that's the number that we were given. And yes, it is coming down slightly, but it was pretty much unchanged here. And it was not as much as folks had been hoping for. Now, here's the real shocker. Here's the next one. If we go back to how inflation was calculated in 1980, we are at 16.5% inflation. So this 8.3, 8.5, yeah, that's the official number. But if you go back to reality, or to where they used to calculate it a certain way, inflation is pretty much double that right now. So no wonder there's a lot of problems going on at the current time. And this is put out by shadowstats.com. If you haven't visited that site, I would recommend it. They have some different data that sometimes can get us some useful insight into things. This is also what I'm talking about. In yesterday's video, there was up over a 90% chance that we would be at 3 to 3.25. That's a 75 basis point move after the September 21st meeting. Well, now, yesterday, there was 0% chance of a full percentage point move, and that's all of a sudden jumped up to being 35% chance. So the Fed may have to raise interest rates even more than what the market has been expecting. And they don't even like what the Fed's doing at 75. They're really not going to like it if they have to go to a full percentage point. But based on what the Fed has been saying, they're determined to get inflation under control. And if it means raising interest rates, even at the sacrifice of the economy, they're willing to do that. So this is now back on the table as well. We're getting closer to the Fed meeting now. Sentiment did drop over. We were neutral after yesterday's session. We've dropped down into 40, but not giving an extreme reading currently. And here's the historical chart. This came out before the big decline, where it shows we're still pretty much in the middle with the Ridex bear bull ratio. Folks, we're not very fearful, extremely fearful or extremely optimistic. The last time we got this reading, expect this to really spike up, because a lot of these folks are reacting to what happened, and they're probably going to get into the bearish mutual funds more, which is going to make this ratio really go up. Here's some Isabel Net charts to look at. We've not seen a lot of changes over here. You see most of these diamonds are on the left-hand side. So folks are having a tendency to find other investments outside of the stock market. If we were in a risk-on environment, that's when people get into stocks. Well, people are still tending to be quite defensive right now. Here's another chart updated of the discretionary investors. These are like you and me, where we can pick a little bit of Google, pick some of the S&P, maybe do some Bitcoin, maybe look at some ETF that's based on a futures contract where we can go long and short. We can kind of pick and choose what we need to do as we go along against a systematic strategy where they lay it out and say, this is the strategy that we use, and we're not going to deviate from that. And it just shows how both have really been suffering and just really going down overall. Then this is looking at the percentage of stocks above their 10-day moving averages. Now, this chart is completely out of date right now. We were getting an extreme negative reading and going up higher. Well, if we blew through the 20 and the 50 and even the 100, what do you think it did to the 10? So this is going to just be really turning back over. So this chart is almost out of date and useless right now. Then we're looking at the asset allocation of global stocks. They're still at an all-time low. And again, this was before the big CPI report came out. It's already been falling. And OW means overweight in equities or stocks. People have been getting out of stocks. And then here's the overall return for the S&P. Well, it's probably not going to help things based on what has just happened. Then this is looking at the 2023 earnings per share scenario, where when this came out, it's kind of where we're at right now, where at the 3,900 level, this is a 16 times PE ratio, which is more fairly valued. Well, their year-end target, at least at the time they did this, was that we were going to get back up to 4,300. That would put us at the 18 PE ratio. And then if we really go into a recession, that's going to shoot things down and get us more into a fairly valued situation. And that could take us down to 3,100. Again, these are interesting to look at. I like to look at the charts. These just give us some reference points that we can look at along the way. This is probably outdated too. It was showing a lot of improvement in the technical score. It's actually going up from the previous reading. Well, with the decline that we saw, this is probably going to come back down. The Fed Fund futures curve, this was also out of date, how they're suggesting that the Fed futures were going to be coming down, and then it's comparing to where they were a week ago. If we saw this chart after Tuesday's session, this is probably going to go spiking back up. And then the economic surprise index. When we're below zero, that means the economic reports are weaker than expected, but they were showing some improvement here. And it'll probably continue to go up a little bit more if they calculate the CPI into this, because it didn't drop as much as they were thinking it would. Here's the dollar spot index. The dollar, which had been going down as stocks have been going up, nope, that all reversed course on Tuesday. The dollar was up really strong as stocks were just going in the toilet there. And this is a sentiment indicator, which is probably also out of date now, just showing that folks were getting rather extremely bearish about things, but not necessarily extreme to the point where we have been before. And this will probably continue to fall as folks react to what has happened. Here is a look at how things went. Look at growth, down 5.2% in the large caps. And mid caps, down 3.9 growth, 3.88, just about even with the small caps. But small caps have been having trouble anyway. But we're just down across the board here. And with this decline, we saw a spike up in the VIX on a closing basis, as well as on the bar chart. And we closed not at the high, but kind of near the high. So folks are starting to hedge, and they're seeing more fear coming into the market right now. With that real spike, we're seeing the VIX of the VIX also shoot up slightly. The Ulcer Index is turning back up after it had been declining while we were going higher. Well, with the decline, and this is just an ugly bar with a gap. I mean, a lot of damage was done here that needs to be repaired if things are going to turn back positive. Yesterday, we were down 14 odd percent. Now we're down 18.39% from the all time high. As can be expected, the equity put call ratio, which did advance on Monday, there were some folks out there that were hedging ahead of this. Well, it really shot up as folks continue to do more hedging, but it's showing an overall decrease still with the 5-period simple moving average. Here are the pivot levels for Wednesday's session. And because we had such a huge run on Tuesday, the pivot points are quite far apart from each other. This is where a lot of damage was done. Yesterday, we were above this pivot and looking higher and actually worried about overhead resistance. Well, we gapped now below the 50-period moving average, came down to this trend line and actually closed below it. So the positive thing that we had been seeing here with this setup, even though we dropped below it here, we were able to close a little bit above it. Well, right now it looks like we've lost this support. Unless we see some real buying coming in that can take us above this trend line, this could spell some further weakness. And now we're looking at going down to this S1 level. And here is just the chart, the daily chart showing the monthly pivot levels. And notice how we came right down to a pivot point here. That's always kind of interesting when that happens. Here's some short-term fib levels. We were showing a lot of improvement. Well, we pretty much have given most of that back now. And here's another look going from the low in June to the high that we set in August. We're coming right back down and giving back a lot of what had been retraced recently. On a short-term basis, going from the high from August to the low in September, we're coming all the way back down. So we could be coming back down to test the September low. If we do break through to the downside, are we going to go back and test the June lows? And what's going to happen if we do go that far? Are we going to bounce up off of that? Are we going to continue to go lower? And everybody has their opinion, but it means nothing right now. We just have to see what the charts are telling us. And if price does come down to this level, then we just evaluate things. What's sentiment like? What's the overbought, oversold situation like? That's where we make our decisions. And it just really gets me when these people, they come up with these generic scenarios of what they think is going to happen in the future. Well, yeah, you can say anything you want and you can have any position that you want, but you're probably not going to be right, because that's why I choose to do a day-by-day analysis of the markets and then evaluate things that way. Yeah, you can develop further out scenarios. I mentioned one earlier in the year, number of months ago now, where when we were going up in March, I thought we were going to go back and set an all-time high, and that was going to be like a washout top. And then we would see a very severe decline after that. Well, I've had to modify that. It was just a scenario that I was running through. But as the evidence started to mount against that, I had to switch that scenario. And I'm still kind of going with the idea that the market is going to have some positive action still left in it, but it may be pretty dicey until after the midterm elections. Here's another fib level where we were breaking above it. Well, we've now broken below that. Longer term, we were coming up to some resistance here, didn't quite get there, and now we've fallen back down. And here's another chart. This is long term, going back from the COVID low to the all-time high, where we had broken above this pretty significant resistance. Well, we gapped below it now. So a lot of the positive things that had been developing are pretty much getting wiped out right now. Doesn't mean it can't switch. We just have to look at things for where they're at right now. All of the sectors were negative, with communication leading the way lower. And the one that was down the least is energy, and they were down 2.52%. Here's the scooter scores showing that energy and utilities are still into the 90s, very defensive plays. There's nothing else until you get down to communication. I don't know if they can have negative readings on this scale here, but getting down to 4 with the communication sector. This is showing the energy sector and then the utilities, which are still looking better than everything else in all the other sectors. Here's just an updated look at how things have been behaving since the all-time high that the S&P set way back in January. All of our technical alerts, at least in the US, were negative. I guess Canada had a positive one with a bullish MACD crossover, but we had the S&P go below 4,100, then below 4,000. The euro was going down as the dollar was going up, but there were no new all-time highs or recent highs set with the dollar. And then the NASDAQ just got crushed. 12.2, 1, 12,000, 11.9, 11.8, 11.7. Not a positive day at all. So our technical scores have really taken a hit as far as the indexes. The mid caps are still in first place at 65, and that's pathetic, followed by the Dow at 45, which is even more pathetic. The S&Ps dropped to third place at 44.8, not looking good. Small caps down to 31.3, when they never really were looking all that great. And now the Qs have gotten down to 16.5. So this is pretty much wiping out this growth scenario that we were looking at, and you'll see those in our other charts. So let's look at what happened. My goodness. We gapped lower. We gapped below S1, S2, even S3. Eventually, we came down to S4. We tried to go below that. We came back up to S4. And then when things were not looking all that good, we saw continued selling. And that's why I have S5, S6. I've never had to calculate those before. So I'm sure somebody has this figured out, but I didn't really look all that hard. But this happens so rarely. You just kind of have to look at this downward movement and go, oh my gosh. All right, then the ADX has switched back over to negative with the decline. The red line is on top, the green line's going down, and we're just barely below 20 right now. Now, this may not last for a while, or it could turn into an extended trendless environment, but we are below 20. We'll just have to see how things go. Getting nothing from the Arun, because we're coming back to prices where we were at not so long ago, and so it's not picking up anything new here. The new highs, new lows, we saw a real solid down day based on price and volume. Still positive, but showing a real decline based on price and showing some weakness below the moving average based on volume. The advanced decline ratio, you see how with a over 4% move, it's like some of these indicators you would expect them to have moved a lot more than they did. We're still positive, but we're declining with the advanced decline ratio. New highs, new lows. See, we did. One thing I've been talking about is we were going up, that there's a real lack of new highs. Well, with the big decline that we saw, there's also kind of a lack of new lows. That's because we've been trending pretty much sideways overall for a long time now. Accumulation distribution, still above the moving average, but has really turned down. And short term, this is where everything is pretty much switched back to negative. This is the advanced decline ratio for 1 day. Yeah. You think we overdid it a little bit? Rate of change 1 day. Yeah, think we overdid it. We lost the 20-period moving average, where yesterday at this time we were above that. So those were given back. Our rainbow, short-term rainbow, we were up near the top of the rainbow. Well, now we're at the bottom of the rainbow here. Here's our moving average tree, starting to show some improvement before. Well, all of that was given back. Stochastics, after giving us a little bit of an extreme positive reading, have now switched to negative. Same thing with the Williams percent R. In fact, they've already gone extreme negative. Force index went from being positive to negative. Swinland trading oscillator didn't roll over as much as you would expect. This might give you some hope. It actually advanced slightly. So that's kind of a positive thing to look at. Now, there have been times when this indicator has been a leading indicator for us, but there's other times when this indicator has fooled us, and it would be nice to know which was which while it was happening, but we just can't do that. All right, McClellan oscillator was looking pretty solidly positive, has now dropped below zero and is negative. We saw declines with the 20, 50, and 200-day moving average. Studies, stochastics, looking a lot more negative now. I mean, just a lot of, man, just ugly, ugly. Rate of change going back 20 periods is also getting to an extreme negative reading. We lost the 50-period moving averages, and that's a big deal. It was a big deal to get them back. It's an even bigger deal to lose them almost immediately. 100-day moving average. After we got that back, now we are losing them. Intermediate term rainbow. We were starting to come up out of that, only to be dropping now. And the Sean trend meter showing weakness. PMO, which was trying to turn up positive, nope, not happening now. We're still seeing some improvement here with the intermediate term oscillator based on price and volume, but it may just take a little bit of time for that to catch up here. And the PMOs that are rising after being extreme positive have shot to extreme negative. The buy signals have turned down, and the percent of PMOs above zero has also turned down. But you see, they're just kind of little tick downs. It's like these indicators are in shock. The Chaikin oscillator has also turned back down. Chaikin money flow turning more negative. We saw a pickup in volume too. And the vortex is still negative, even though the red line is declining, but the green line is also declining as well. Now, one thing that we can kind of take it from this is maybe it was overdone on one day. The markets do overreact, you know. It's kind of like a seventh grade relationship sometimes. And maybe we went down too far too fast, and there might be some sanity that comes back. But we have other reports coming out, the PPI. We have a scenario that the market now, for the multiple time this year, third or fourth time, they've tried to develop this scenario only to have it shot down. Are we just going to be able to bounce up easily out of that? All right, then the summation index, it's really hard to see, but it's turning down based on price and volume. That's based on the McClellan oscillator. And some of these oscillators were starting to show some improvement. Not so much now. The slope, it's actually switching over a little bit positive, but will probably roll over quickly. BPI, this is still hanging in there where we're still above 50, even though we did have a decline. Ease of movement showed a decline. Ultimate oscillator, decline. Money flow, see just a bit of a tick down here. And then the 19-day exponential moving average, this was showing a lot of improvement. Well, we're showing some more weakness now. And on volume, we've actually dropped negative. TTM squeeze. Again, this one, it's like, what's going on here? It's still giving us more of a positive signal right now. So we'll have to see if these indicators catch up. Balance of power just turned down slightly and is above the dashed line. And we're seeing a bit of a decline with the CMB composite index after giving us a positive signal and then a confirmation of that signal. So yeah, even our charts got whipsawed. The Heiken Ashi has now turned to negative with the dark candle. The Kegi is still positive, but is showing a decline and could probably redraw as a red line anytime now. The Renko chart is looking more negative. 3-line break hasn't really picked up things yet because we're kind of in areas that we were in not so long ago. The point and figure did draw in 3 red circles here. There's no signal yet, but this is picking up the negative price action. Our elders for the S&P has switched. It was positive. Now it's gone back to negative. And the same thing for the SPY. The SAR, this is the one that's hanging in there, even though this can be a great indicator when the trend is really going nicely in your direction. But look at the drawdown that you might be taking with this, but it's still giving a positive signal. The go, no go system has gone back to the deep purple smoke on the water look here. So that's much more negative, and it's given us another no go. All right, long term. Rainbow, we got back up into about the middle, and now we've been dropping back down. Weakness with our 50, 150, and 200-day moving averages. Special K never did turn up and just declined a little bit more. Diamonds, negative. After getting right up to this pivot point, we have been rejected above the 50-period moving average with the Dow. The Qs, after getting above this moving average and falling down, it's negative. Coming up to this pivot point, again, dropping below the 50 and declining. The Vixen spiked up with the decline as well, both with the bar chart and with the line chart. NASDAQ, after coming up to the pivot, fell below the 50 and is really declining. Mid caps, which have been kind of giving us some hope there for a while, they were doing about the best. Well, not so much now. They dropped below the pivot and the 50-period moving average. The Wilshire also broke through support that had been gained. The dollar was up 1.38%, so it's still in a pretty solid uptrend. And the S&P to the dollar, they're still having a pretty strong inverse relationship. So if the dollar's going up, the S&P is going down and vice versa. Gold really fell off again after having a nice bounce on Monday. Silver was also down, actually was able to get above its 50-period moving average, but has been declining and is in an overall downtrend. Oil, it even got hit a little bit, down to 87.31. The correlation between the S&P and oil, it's right at neutral now. Bonds also, with this ETF, also saw a decline as interest rates continue to go higher. We're starting to break below the COVID low with the World Bond Index. The stock to bond correlation, it's weakening a little bit, but they have a tendency to go in the same direction. And that's what they did. Stocks went down and bonds went down on Tuesday. Yield curves still 10 to the 5 is inverted, 10 to the 2 is inverted, 10 to the 3-month stays ever so close, but does not actually ever go inverted, at least yet. Here's the tech to the 10-year. They're back to a neutral correlation. Here's the real spike up that we saw across the board in yields right now. Our scenario is back to being on hold, but there is one thing here. This is the Copic curve. This could be getting ready to cross. We'll keep an eye on this. Now, this doesn't tell us the direction. This just says that a major change might be happening. But I will warn you, as we were going up, we were seeing these lines coming back to each other. Now that we saw the decline, this may readjust and actually turn back down because it was picking up this move right in here. So again, this doesn't tell us the direction. It just suggests that something might happen, but it has not generated a signal yet. Those above their 200-day moving average, which had been showing an improvement, are now showing weakness. The same thing with the 50-period moving average in the S&P, the mid caps, and the small caps. The 10-day average of the highs and lows really didn't change all that much because we never saw a real breakout to the upside, and we haven't seen a real significant breakdown to the downside. So it's kind of just hanging down in negative land. Then when you take the broad market look at this, we're not seeing an awful lot of change here either. So it's price movement. It's not the new highs and new lows that are really, that's the strength underneath the hood that really can build in this market momentum. It never really kicked into gear, at least yet. The equity put call ratio is continuing to decline after almost spiking up, and we're still working above this other spike above 0.8. Small cap index, after coming above the 50-period moving average, is now broken down below that. And even though the small caps were down, they weren't down as much as the S&P, so the ratio turned up slightly, but it's not giving any kind of an improvement to this chart. And the S&P to the 10-year yield, they're kind of neutral, but having a slight tendency to go in the same direction. Here's our sector rotation, weakness with the Qs. Even discretionary rolled over, and they've been kind of the hidden gem lately. But large cap growth to large cap value is also seeing a decline. Here is the large, mid, and small caps showing less of a decline with the mid and small caps, but still looking more negative. Correlation between the S&P 500 and the 2-year yield has gone back into neutral land, and we're starting to break out. We've taken out this other spike, and we're starting to go above that right now. So this scenario is not necessarily viable. Here's our S&P utilities ratio. If there was one thing that I pointed out in yesterday's video that was kind of a warning sign, was this. We want to see this turn and go back up if that's going to help support the S&P 500. Well, it was still pretty low and declined even more in Tuesday's session. So this is suggesting continued weakness. Now, doesn't mean it's always going to be right, but this is just not really helping things at all from the positive side. Staples were down 3.33%. I mean, everything got hit. And so it spiked back up in relation to the S&P 500, but we're still working off of this spike, just not seeing any follow through with price, especially on days like Tuesday. So what's our outlook? Technicals, yeah, they're back to negative right now. We do have the weekly MBA mortgage application index. We've been seeing declines in that as interest rates go up and as house prices go up. Less people have been trying to get mortgages. We'll see if that improves. We have the producer price index coming out, and then the geopolitical events. And there's one new thing here that came out that kind of freaked the markets out on Tuesday, is because of what's going on between China and Taiwan and the US, there's starting to talk about some sanctions against China, which could have some supply chain issues. They're already dealing with the lockdowns there. And you notice our China list is getting a little bit longer now. Yeah. So that is being blamed on a lot of the increase in weakness that we saw later in the day on Tuesday. So we'll have to see if anything comes from that. So our scenarios, we have to go with the down scenario if you think we're going to kick back into a trend because of all these crazy things that are happening, all these headwinds. The technicals are pretty much back negative now. We can't go with the up scenario, especially after a 4+% decline. We're putting our scenarios and our setups and our rotation back on hold. The technicals, which had been showing some improvement, that was pretty much all washed out. And you could go with a sideways trend right now or neutral because the ADX is below 20 and it switched back to negative. So our conclusion, the S&P switched back to being negative. Surprise, turning negative, and it's actually negative in the short term as well as the intermediate term and remains negative in the long term. So thank you. I hope you found this useful. My goodness, we'll just see how things go from here, and as the market participants lick their wounds and see where things go next.